Happy evening, friends. I welcome you all for this session, for this webinar session uh, organized by Anvation Business Solutions. And to introduce myself, this is Arun, partner at Anvation Business Solutions. And I have my colleague, Mythili. She's also part of consulting division at Anvation Business Solutions. And a brief about Anvation. So Anvation Business Solutions was formed 15 years back, headquartered in Bangalore, and has branch in Chennai and Delhi. It started with an intent to provide solutions to business on various aspects such as regulatory, legal, and commercial aspects. However, over a period of time, we have grown into a full-fledged consulting firm providing varied services. So to name a few, these are our services. A brief on our what service offerings. So one is transaction advisory services, valuations, tax advisory. Tax advisory, both including direct tax and indirect taxes, FEMA advisory, structuring and restructuring. We have started a niche area of late in the last 3 years, advising on estate planning and setting up of private trusts. We also provide virtual CFO services for effective management. We also help, for the targets or the investors with respect to due diligences. Apart from that, we also provide corporate law services. So these are some of the offerings that we provide to our clients. Just a brief about us. So I think most of our delegates are joining still, but in view of not wasting others' time, we will dwell into the subject matter of the webinar, today's webinar. So today, as I mentioned, we are talking about long-term compensation plans. It's mainly focused on the employees and the consultants and the various stakeholders that participate in the growth of the business. So this is a brief, the flow of the webinar that we would, take you all through. And please note, as of now, we have not given, mic and the video rights. We will enable it at right time. In the meantime, if you have any questions or any queries on the subject matter during the course of the session, please post your queries on Q&A section. And our organizers will pick it up from there, and we will try to attempt to address those queries during the end of the session. That is one. Number two, we will also launch small polls in between just to gather certain information and to make it more interesting and interactive. So request you all to attend the polls also. So the flow of the webinar would be mainly to start with to brief about the compensation plans, key aspects of compensation plans. Then we will also dwell into a little bit of how the implementation happens, the roadmap on it. And then after that, we will also touch upon briefly on accounting and the tax aspects. And then we'll step into the Q&A. Okay, a brief overview of compensation plans. It's a mechanism where the the management of the company or management of the business or the promoters of the business would want to compensate for the services rendered by the stakeholders. I'm calling here stakeholders. I'll explain in a moment who are the stakeholders. But it is a mechanism to compensate stakeholders for the services rendered either in the past or in the present or in the future. So, and it is also a mechanism to retain the skilled workforce. So, the the skilled workforce, any which ways they are, remunerated on a monthly basis, the salaries are paid. Apart from that, where there are key employees, key performers in the organization, the this compensation plan helps the promoters or the management to compensate additionally over and above their regular monthly remuneration, and also help in retaining them. So that is the core, the purpose of this compensation plan. And this can be structured either in terms of monetary nature or non-monetary nature. We will touch upon what is monetary and non-monetary in the subsequent slides. And also, as I said earlier, it is a service offering rendered by stakeholders. Who are those stakeholders? They can be employees, consultants, internal or external, and also vendors. These are the people to whom the entity can look at compensating in the form of compensation plans, long-term compensation plans, apart from the money settlements. So why compensation plan also? Why compensation plan also? So as we all understand, of course, the common format or the generally accepted format is ESOPs. ESOPs being the generally practiced format under compensation plans. We all are aware that the benefits of ESOP. One is increased productivity because the ownership is created, the responsibility comes up amongst the employee group, and hence it increases the profitability and productivity and also results in profitability. That is one benefit. Ignites employee morale. Basically, it helps in improving the morale or keeping the morale high amongst the employee group, and attracts and retains top talent, where the value is created because of these employees. It is a chain reaction. So these employees create value, and that value attracts more talent, and the talent again is offered compensation plan, and then hence it also again contributes to the growth and the value proposition of the organization. So in a way, it is a chain reaction effect. So this is what it creates, helps create. Okay, that is the other point. And it reduces the attrition rate amongst the employees, and hence the retainability percentage goes up, and that is attrition rate falls, and hence longevity of the employee staying with the company adds to this stability of the operations, and in turn the productivity. So these are few of the points which we wanted to emphasize on, which are actually the contributors or the end results of compensation plans, implementing compensation plans. So in our group here, I know we have varied mixed audience. We have people from corporates. We have people who are acting as coach and advisors to the boards, and we have practitioners, tax and business practitioners. So they can look into this aspect and then use this as an advising mode for their clients or organization. So under compensation plans, as I mentioned earlier, we have two types of or two broad categories. One is equity settled plan, another is cash settled plan. So here onwards, I would request my colleague Mythili to take over and explain us more, dwell into the equity settled plan. Over to you, Mythili.
Thank you, Arun. A very good evening to all of you. Looking forward to a great session for today. So, moving ahead with the equity settled compensation plan, we have what is commonly, we are all aware that ESOP is something that always first comes to our mind when we talk about equity settled plans. And most commonly used mechanism in the current world in regard to incentivizing employees who are part of any organization and to enable them to be part of the growth story of the organization has been ESOPs. Now, with regard to ESOPs, why ESOPs? Why does an entity actually decide to give out ESOPs? It is also to demonstrate to the employees that they are part of the wealth that they are creating in the organization, that they are part of the growth story that is happening. Now, with a typical ESOP scheme, the person who are identified as beneficiaries of the scheme, which are generally employees, are allocated shares which they have the right to exercise the option to buy shares at a future date. So the benefit of the scheme is that the shares are not immediately granted. You have the concept of incentivizing so that they stay longer in the organization, whereby you have what is called as a vesting period. So in order to ensure that the talent is retained, companies give out ESOP to ensure that the employee stays with the organization for long. It is a very highly effective retention tool, and that whatever that they contribute to the company in terms of value is they see the benefit of it through wealth creation in the company and as well as their personal wealth creation. Now, moving on, we have identified what is an ESOP. Now, moving on as to how does the entire ESOP come into action? So once we generally see as part of any fundraise and any equity fundraising that happens, that we create a carve out of an ESOP pool where we say that it is typically in the range of 5 to sometimes even to the extent of 15% of the total equity of the company, where we create a carve out and we say we create a pool, and that pool is being created in order to be offered to the employees in future. So that is the first step in terms of first step in terms of creation of an ESOP. Now, post creation of the pool. So what happens is once the management decides to go ahead with implementing the ESOP plan, they need to have a comprehensive ESOP plan in place. Now, the ESOP plan acts as the major driver for um, the entire benefit that's given out. It is like a master document. It is extremely comprehensive. It gives the entire mechanics of how the benefit gets moved to the employees, what are their rights, who has got the powers. It is as good as how a company has an articles of association. So it is the acts as the entire driver of this entire ESOP. Now, an ESOP plan is very critical because once the master document is created, there are very few instances where there are changes that are made to the ESOP plan unless there is a conscious management decision to make certain changes. And generally, any change in the ESOP plan is not done unless it is beneficial to the employee. So it is not adverse. We generally ensure that it is not adverse to the employee. So that is one part of it. Now, once the entire plan is created, the next step is in terms of implementing the plan. Now, as we know in companies, the main implementer of the any of the operations of the company happens to be the board of directors. So the ESOP plan, fully drafted working plan, is actually adopted by the board, and it is presented to the shareholders for their blessing. Now, after the shareholders approval, then we go to the concept of okay, now that the plan is created, what next? Now, the once the plan is created, the next step is in order to identify what is the total pool that is there and identify who are the employees who are part of the plan. So there would be people who have been associated with company for a very long time. and there would be people who would have joined the company very recently. So the management takes the driver as to how much of the units need to be allotted for each of the employees, and they create the entire pool, and the pool is distributed among the employees. Now, there is no requirement that the pool needs to be outright distributed. The pool can be distributed either in portions where you can allocate only a few portions of it, and then subsequently over a period, the rest of the ESOPs are also granted over. Now, having said that, the next aspect of what is the implementation roadmap is that we have a plan and we have put it in place. Now, then the curiosity component as to what actually forms the core of the plan. So, with regard to the plan, the entire ESOP plan, I broadly touching upon the key aspects of the ESOP plan. The ESOP plan basically calls out as to that we are creating so many units as part of the plan, and then it defines what are the number of units that are allotted as part of the plan. It defines who has the right to administer the particular plan. So in most cases, it might be the board of directors of the company, or in certain cases, if they have decided they want to include certain other people such as HR and others critical uh, employees who need to be part of the decision as to for the grant, they create what is called as a compensation committee. And the compensation committee decides what is the number of ESOPs to be granted to whom. And they are responsible for managing the entire scheme by themselves. Now, the other important thing the ESOP plan also spells out is the mechanics of how the plan operates. It calls out the powers that are vested with the administrator, whether they can amend, they can cancel the options, they can issue more options, they can create what is called as an accelerated vesting. So the entire mechanics and how the plan is implemented is completely the onus is on the directors or the administrator, or who, if it's a compensation company, it's a compensation committee. Now, this is the core aspect of the plan. The plan also calls out the vesting condition. Now, the vesting condition basically says when a particular employee is entitled to the particular option. The employee can be entitled to the option on either being with the entity for a certain time frame. For example, he can be, if he is there for an entity, say for 4 years, then the units that are granted to him doesn't vest immediately. It it happens in phases, like in one portion in 1 year, then the second portion, and then the third portion. So you can create what is called as a vesting schedule. Now, this vesting schedule can either be time-based, where it is based on the number of years the employee actually spends with the company, or in certain cases, the plan also provides for an case where there is a performance condition. In case the particular employee reaches a certain milestone, which may be a turnover or a number of orders he brings to the company, which the board might provide as part of the compensation package itself, and create a vesting condition which is based on performance criteria for the employee. Now, apart from this, it also calls out an important aspect which is called as exercise. Now, exercise is a point where the units that are granted and that are vested with the employee actually converts into shares, and the shares are allotted to him. Now, how much is the exercise price? It could be sometimes the face value of the particular share, or in certain cases, it can even be the fair market value of the option on the date he exercises. So it calls out specifically the mechanics as to what the exercise price. And in certain cases, it also it since it is a major driver for the entire mechanics for the plan, it can also specify what are the situations under which what happens in case if it's an employee related situation. For example, if the employee is terminated, it can spell out specifically whether he would be entitled to the vested options or would the vested options become cancelled. What happens in case of resignation? What happens in case of a death of an employee or in circumstances where there is a disability of an employee and or a person retires? So it can become so minute as to address specific situations and how the plan gets implemented under those situations. I mean, generally, it can also be customized to the extent that it need not be the same for all companies. Some of the companies can customize it based on their requirements. So this is something which is beautiful about this particular plan. And it would also cover situations relating to the company, such as what happens in case there is a acquisition subsequently, where any new shareholder comes in and takes control, or there is a substantial dilution of share of the existing promoters. So it can address any number of situations, and you can specifically call out what would be the mechanics under that particular situation. So it covers both employee related events as well as the company related events. In some cases of plans, they also give an option what happens in case the if the company suddenly wants to cancel the plan and they want to provide cash compensation in lieu of options. You can even define the situations under which you can have a cancellation of the plan, and in lieu of those units, you can offer it as cash settlement to the employees. So this is the main essence of the plan. Hence, it is quite important as to how the plan is drafted, because once it's created, it becomes like a Bible to the organization, and it provides the way forward as to how the scheme will operate. Hence, a sufficient precaution has to be taken in terms of drafting of the plan, and specifically calling out circumstances. A lot of thought and a lot of efforts need to go into drafting this particular ESOP plan. Now, over to you, Arun.
Yeah. Thanks a lot, Mythili, for taking us through and giving a view, in fact, a detailed view on how the ESOP plan has to be structured and the nitty-gritties of that. Thanks a lot for that. Um, Members, we have actually captured some of the frequently asked questions. Of course, this may be sometimes very, specific, very case specific, but we have tried to cover few questions that are frequently asked, but we have tried not to bring the basic ones. So keeping that in mind, we thought we will choose few questions here and discuss a little bit elaborately. The first question is, as Mythili said, ESOP, under ESOP, once it is granted and once the options are vested, the employee has the right to exercise his options. When the exercise happens, the organization, the company has to allot shares. Now the question comes, once the employee becomes shareholder, because the shares get allotted to him, he becomes shareholder. So the question comes, will he participate in all the shareholders meetings and will he have all the rights as a shareholder? So that is where there are instances where we have observed the promoters or the management intends to provide non-voting rights shares. That means the shares does not carry voting rights. So that means to say the bottom line is any type of share can be allotted. It can be equity. It can be equity without voting. It can be preference share or a different class of share. Anything can be structured under ESOP, and there are no restrictions under the regulations. So that is one aspect. Now the question comes up is, why would anyone get exercise their options? Because they foresee that in future the employee would want to exercise. They would want to exit and then cash out. Basically, they would want to realize the money out of those stocks. So the question comes up, if it is a non-voting based shares, would anyone buy it? Generally, investor would not like to buy non-voting shares because he would want to participate in all major aspects of the decision making with respect to the company and its business. And hence, generally, people, external or third party or investor would resist to buy non-voting rights. Non-voting shares with non-voting. And hence, the question comes up, can we convert these shares, non-voting shares, into voting shares? Yes, the answer is it is possible to convert, and it can be aligned and timed appropriately based on the circumstances involved. Next, is there a minimum vesting condition provided under law? Minimum vesting condition is the employee has to, once the grant happens, the employee has to go through the vesting period, and post the completion of vesting period, he is able to exercise his options because it gets vested. The options get vested. That being the case, what is a minimum minimum period under Companies Act for ESOPs? It says minimum vesting period is 1 year. This is a regulation, this is the rule that has to be followed. So even when you're looking at your organization for granting ESOPs to your employees, please ensure that minimum period is maintained as 1 year. Next, what are the startup benefits that the entities as a startup entity recognized and registered with Startup India get with respect to ESOPs? So under ESOPs, the first benefit is even the promoter group are eligible for ESOPs. Otherwise, it is not generally. And a director who either himself or through anybody, any corporate or through his relative holding more than 10% also is eligible for ESOPs. Otherwise, generally, if it is not a startup, he is not eligible. Okay. And both the above relaxation is available for a period of 10 years from the date of incorporation. So that is the benefit that a startup can enjoy. Next, can ESOP be cash settled? As Mythili already addressed this point, yes, it can be cash settled, but it has to be documented appropriately. Next, exit scenarios. As I mentioned earlier, employees would want to exercise the options that get vested with them only purely, because of the monetary terms or the value that it carries. And that being the case, they would want to see the exit also happening and realization happening towards these grants. So that being the case, there are different mechanisms, different ways of building an exit scenario, and this has to be documented appropriately in the scheme so that there are no ambiguities. So one of the examples that we just brought it up here is when the dilution happens by the promoter group beyond 50%, that is when all the vested and exercised options will also participate as part of the exit, provided there are secondary transaction happening. Secondary is where the share transfers happen from shareholders to the new investors. So this is one situation. Similar to this, we can have multiple situations, a combination of situations and events which can be built as part of exit scenarios into the ESOP scheme. We can make it complicated or we can simplify it also. So these were few frequently asked questions that we felt we should bring it up as part of discussion. Of course, apart from this, there are other FAQs also, which we can address it later. Over to you, Mythili.
Yeah. Now getting to the next aspect of the life cycle of an ESOP. Now, a life cycle of ESOP is very critical with respect to multiple aspects. You have various facets for that. One is your accounting. It is important to understand what a life cycle of ESOP is. With regard to taxation, also it has an impact. And also to for the employee himself to understand the units have been granted to them. Would they actually benefit right away? To understand that as well, a life cycle of an ESOP is very critical. There are three distinct stages in a ESOP life cycle. One is the grant, when the units are offered to the employees. This is through a grant letter and an agreement which the employee executes with the company. And the grant letter calls out how these are the total number of units that's been offered and what is the vesting plan. The vesting plan also is included as part of the agreement as well as the grant letter. Now, once the ESOP options are granted, it is not yet a share. It is still ESOP options. So the next stage for it is to vest so that he gets the right to exercise and get the share. Now, the vesting is usually very critical because it is generally meted out as a condition. So units that are granted doesn't immediately vest. It vests based on either a time period, which is called the vesting period, which can be a service period, or it can be indexed to his performance, he having performed certain KRA or agreed performance numbers with the management, he would be entitled to certain number of units. Once the units are vested, the units are accrued to the name of the employee, and subsequently, the scheme can provide a time period within which these vested units can be exercised. Now, the vital phase in this whole ESOP life cycle is the exercise. That is when the units that are to the credit of the employee gets converted as shares to his name. Hence, when it is in grant and vest phase, he would know that this is what is entitled. But it is in the exercise phase is that where the shares are given to his name. Now, moving forward to what is the impact of this on the employer and the employee, I'll go with what is the employer impact on employer. Now, with regard to employer, there are three different areas. One is with regard to accounting, and the other is with regard to valuation that surrounds the accounting. And the important other issue is the taxation. Now, addressing first the accounting and valuation with respect to grant, vest, and exercise. Now, at the time the units are granted out to the employees, there is, since we are giving it as units to the employees, there is a requirement to value the units as per a certain specified methodology. Now, if it is a share, it's much easier to multiply the value of the share and into number of units and grant it. But accounting is sometimes not so simple. So what it does is it creates what is called as since it's an option to get a share at a future date. So we won't know what is the value of the share at a future date. It prescribes using an option methodology or model in order to ascertain the value of the options. Now, when you say option methodology, there are multiple option methodology that is available, like very commonly used Black-Scholes methodology or a binomial. So once the company actually has an ESOP scheme in place, the realization that we have to do the accounting generally dawns towards the end of the year. Now, because you have to adhere to the requirements of your guidance notes and gap, there is a requirement to do as prescribed. The institute has come out with a guidance note for share-based payment, which actually specifies what is the time you recognize it as a liability in the books and how to record it. Now, generally, this has not been called out anywhere, but as a practice, what we generally prescribe is that you get a valuation certificate of a registered valuer, since the books of the accounts are done as required under the Companies Act. And the Companies Act generally recognizes registered valuer For valuation purposes, we prescribe that you get a report of a registered valuer for valuing these options, and based on the fair value of the options, you carry it on the balance sheet and charge it in the books as expenses. Now, this is at the time of grant is when you do it. And now you have, say, for example, 10,000 units, and the 10,000 units are vesting over, say, 4 years. Now, it is going to be 2,500 units per year. You can't recognize it as an expense in the first year itself. You will have to recognize it over a period. So it is for that purpose, the vesting period is very, very critical. How would you allocate those units over the period would be based on your vesting schedule. So though you determine the value of the options, the value of the options is taken as expense over the period of the ESOP based on the vesting schedule. So that comes to that. And next, we have a requirement when what happens at the time of exercise. Now, when we go to move to the exercise phase, we have a requirement that once the shares, once the options are converted into shares, and the shares are allotted in the name of the employee, there is immediately it attracts the perquisite tax. Now, under the Income Tax Act, it specifies that you need a valuation from a merchant banker at the time the employee exercised the right, and this would work as a driver for you to do the differential in the accounting. One of the most important things to note here is that the valuation specifically is done only at the date of grant. There is no requirement for restating the fair value of the options every year, because obviously with the current startup sector, how it is working and how valuations actually pan out, now, there is always a constant movement based on the milestones the startup achieves or the company achieves, whereby the value is not constant and it moves. But for the purpose of accounting, we don't, since it is a future liability that is likely to happen, we take it only at the time of the grant, and then we report that this is what is the round. And then finally, when the liability crystallizes, the balance comes through the profit and loss account. Now, this is on the accounting and the valuation mechanics, what is required. Now, coming to the next part, which is taxation. Now, whether ESOP is called out specifically under the Income Tax Act. My apologies for people who are not who are not part of the who are not familiar with the regulatory side. I'm going to stress upon a little bit of sections here. The ESOP is not called out as a specific deduction under the Income Tax Act. So what happens is you have what is called as a residuary clause, where expenses are allowed under for business for ascertaining what is the income of a business. Now, under under the residuary clause, it we have to check whether ESOP is a possible expense under the residuary clause. If it is, then we can go ahead and claim it. So Section 37 of the of the Income Tax Act, which actually calls out whether ESOP can be allowed as a deduction, we have to examine one important requirement. It says it should not be a capital expenditure, nor it should have a personal expenditure. It should not be anything that is contained in other sections. ESOP is not certainly called out. And then it should have been wholly and exclusively for the purpose of business. So having weighed these aspects of the residual section, we can conclude that ESOP expense can be claimed as an allowable expense, and we can claim it under Section 37. But since there is no specific call out as to when to claim it as an expense. There is a very strong Karnataka High Court decision called the Biocon case, which provides that ESOP expenses, even though it is in the nature of a loss, because the ESOPs are, even though the fair value of the ESOP is higher and the actual excise price is lesser, the difference can be claimed as an expense. And the decision specifically calls out saying that this can be provided at the time of grant of the ESOP itself. So this might be a litigative area, but this is possible to claim it. And how do you claim it? Of course, the vesting condition would work as a driver in order for you to claim it as part as an allowable expenditure. But what the Income Tax Act certainly recognizes is to with regard to the TDS on this ESOP. Now, just because you recognize it as an expense in the books, it does not necessitate the deduction of tax at source. So the TDS is specifically called out at the time when perquisite liability crystallizes. So at the time when the perquisite liability crystallizes, which is at the time of excise, is the time when it is when the requirement of tax withholding arises for the employer. Now, this is with regard to the employer side. I'll move to the employee side. Now, with the employee, it is quite straightforward. Since it is only a right to subscribe to shares at a future date, on grant and on vesting of the ESOP, there is no taxable event in the hands of the employee. But at the time of exercise, as we discussed earlier, we can it is taxable as a perquisite in the hands of the employee. But having said that, the the Finance Act has provided a benefit to eligible startup, and I hereby specifically called as eligible startup and not a startup. Now, as we all know, to be registered as a startup, we need to make an application to DIPP. And once we make an application as a startup, we get allotted the DIPP number. Now, the common impression is that just because we have a DIPP number, we are called a startup, but it doesn't mean we get all the benefits under income tax that are accrued to a startup. So there are specific benefits in the Income Tax Act which are provided only to eligible startup. Now, what is an eligible startup? Now, apart from the general conditions as to what a startup is, you have an additional condition which says you have to hold a certificate of eligible business from the Interministerial Board for Certification. This certification, this particular certificate is not immediately granted on you being registered as a startup with a DIPP number. You need to specifically make an application in a prescribed form and get this particular approval. Only when your startup is then considered as an eligible startup that you will have the benefit to pass on to the employees, which is postponement of that perquisite liability that comes to their hand. Now, so in most cases, considering the valuation numbers that generally happen in a startup site, when they actually exercise, the value is quite low. But just because the value is there, it doesn't mean they have it in the form of cash. It is in the form of shares. And only when the shares actually find their liquidity do they actually have the money for them to understand how much is the real value. Otherwise, it is only to the extent of number of shares into the FMB. Now, the government too does recognize the fact that this is an issue with the startup ecosystem. So they have provided a benefit to all eligible startups, saying that once an employee can postpone his liability to a maximum of 5 years or the date of sale of the security or when he ceases to be an employee of that particular company, whichever event happens earlier. So he can postpone the liability that arises to him on exercise to any of these three, whichever event happens earliest. So this is quite important and pertinent to know. And as an employee side, it is very important in the sense that because it's only the company would know whether they made an application. One of the critical questions the employee might need to know, understand is whether though it is a startup, whether it is an eligible startup. Now, I'll briefly also touch upon the aspect of ESOP and the FEMA regulations, because in the current scenario, we see a lot of structures which doesn't work as silos. So you have a couple of structures where there is a subsidiary in India or a subsidiary overseas, and employees are provided this benefit of employee benefit plan are offered at a global level, on the group level, and the employees of the group are provided the particular ESOP plan by different entities, though they are not directly employed by the entity. If they are associated with that entity, that they are provided this benefit of ESOP plans. Now, ESOP happens under two aspects. One is where there is a foreign direct investment, that is the money coming into India. If an Indian company provides as part of its plan any ESOP to an overseas entity, that would qualify under the FDI regulations, which is the non-debt regulations. Now, the non-debt regulations provide as to what are the kind of entities, employees of what kind of entities are eligible for this. It calls out specifically your holding company or a joint venture or any wholly owned subsidiary. Any of those employees can also be provided the stock options. So it is would be all part of a global plan where they would be given they would be granted the stock options. Now, once the company is allotting shares in India, that is the shares are being provided to a person who is not resident in India, he is getting shares of an Indian company, then there is a requirement under the FEMA regulations to provide a specific form called as the form ESOP, which the company will have to file. Of course, this is subject to whatever is the sectoral cap, because this is as good as allotment of shares for certain services, and it is like money coming into India. So there would be requirements of sectoral caps, and we'll have to be cognizant of that. So just like how an employee overseas can be provided benefit under ESOP, we have one more regulations where it can be the reverse scenario, where if it is an Indian employee is part of a global ESOP plan, and he can subscribe to the particular global ESOP plan. Now it is a concept of money going out of India. So we have a recent amendment to the regulations, which is the overseas direct regulations, whereby it provides now under the current scenario, whenever an employee or a person makes a remittance out of India, it happens under what is called as an LRS. The LRS is a liberalized remittance scheme under which it provides that every person can remit outside up to 250,000 US dollars per year. Now, this is the overall cap that has been given. A person who is actually subscribing to a plan, which is a global ESOP plan, and he is remitting out of India, it will have to be done in accordance with these FEMA regulations. And you have, since in most of the cases, there might be not a case of control, but it will be a smaller portion from the entire pool. Their equity might not be as high as 10-15% and all, and certainly some cases there might not be control. So this can be done. These kind of remittances would be classified as overseas portfolio investment, where you don't have control, but you're holding a small percentage of the equity, and you will have to file the necessary forms for making remittance for the excise price. So this is one other aspect, because in the current scenario, we've seen a lot of cross-border transaction and cross-border structures where you have a holding company overseas and a subsidiary in India, or the other way around, and where the employees are part of a global group, and they are benefited through ESOP plans from a single entity, which they are not be probably employee of, but will be associated with it. So this is to briefly touch upon that.
Thanks a lot, Mythili. So the next topic is on sweat equity. And of course, Mythili took us through the regulations and the compliances. Of course, it is a vast area, and a short period is not enough to touch upon every aspect, but we have tried to cover it on the accounting side, the taxation, and other regulatories like FEMA. Uh, Moving forward, we will discuss briefly about sweat equity. However, we will just launch a poll. Our colleague will launch poll. Parallelly, I request all the delegates here to exercise the poll and then give your inputs. And parallelly, we will take you through the further session. The poll, if it is not available on the screen, it will be available in the chat also. There is a chat section. You can go to the chat and then exercise your poll. Okay. So moving forward, there is another concept called sweat equity. It is very similar to ESOP, but of course, it is not exactly same as ESOP. The reason is ESOPs under Companies Act is available only for employees, and in case of startups, certain exceptions, it is available to the directors and promoters. That being the case, uh, the Companies Act has also brought in a regulation around sweat equity, wherein it purely recognizes stocks provided, shares provided to the directors, you know, or employees for the value add that they bring to the table. So what is that value add? It can be intellectual property rights, transfer of intangibles. These are the situations where the company or the board can decide to grant sweat equity. However, the difference between the sweat equity and ESOP is there is no vesting period for sweat equity, unlike 1 year vesting period for ESOP. There is no exercise, there is no vested options concept under sweat equity. The moment the intangible property rights or IPRs or intangibles are transferred and in the name of the company, the shares are allotted. It happens immediately. That means there is no grant given, there is no vesting period, there is no vested options concept. There is just straightforward share allotment that happens in the name of the employee or director for the services provided. That being the case, let's see what happens. Just a minute. So, as I mentioned, the difference is the allotment is made to the recipient immediately. That's one variation compared to ESOP. And there is no right to exercise as such. And hence the shares get allotted immediately. So what happens here? Because of this, what is the regulatory impact? Let's briefly touch upon that. One is valuation requirement. So under valuation, in case of sweat equity, uh, valuation of the service and valuation of the instrument. When I say instrument, it is the shares that are granted, has to be approved by the board. It has to be obtained by a registered valuer. Unlike in ESOP, here valuation of service as well as valuation of shares are necessary. That is one aspect. Under Companies Act, there are thresholds or the limits provided for sweat equity. That is, number one, not more than 15% of the existing paid up capital can be allotted or allotted under this scheme or under this model to the employees or directors. That means not beyond 15%. And it cannot be beyond a value of rupees 5 crores. Whichever is higher will act as threshold in this situation. Okay. And the other condition is it cannot be beyond 25% of the paid up capital at any time. That means it is cumulative condition. So all the past sweat equities put together cannot exceed 25% of the paid up capital at any point in time. So that means to say, as and when the capital increases, the threshold also, the further allotment also increases. Next, since this is being given generally to the directors, sweat equity is given to the directors for a service rendered, there would be a GST impact, and this has to be taken into consideration. And GST works on the value of the service provided, and hence the GST liability has to be discharged by the service provider, and hence it has to be collected by the service provider from the company. So this has to be taken into consideration. Okay, and there are other considerations, other compliances that needs to be done under Companies Act for allotment of shares for consideration other than cash. That is the other aspect. And of course, in case of startup benefits, the above threshold is substituted with 50%. That is, instead of 25%, the threshold is increased and provided up to 50% for a period of 10 years from the date of its incorporation. So what happens post 10 years? It gets reset to 25%. So this is all about regulatory impact with respect to this sweat equity. And then I'll hand it over to Mythili. Meantime, we have one more poll which my colleague will launch. Please address it. Over to you, Mythili. So Mythili, you can continue in parallel because keeping in mind the time. So friends, we will try to accommodate 15 to 10 to 15 minutes as Q&A session in the end. So we'll try to go at a faster pace here.
Okay. Now, with regard to a cash settled compensation, we have so far seen a case where you have the equity being allotted to the particular employee. Now we have a concept of cash settle. Now we have what is called a concept of phantom stock and stock appreciation rights. When I say phantom stock, it is often called as a shadow stock. When you say stock, it doesn't mean actually there is an equity that has been allotted. It basically replicates the value of the shares. So the value of the phantom stock or the units that's been provided to the employee will be tagged to the fair price of that particular share, and so many units into the fair price would be the value that the person would be entitled to. So this is one alternative method of compensation plan that has found usage in the current times. That is one. And the other alternative to this phantom stock is what we call as the stock appreciation rights. Now, the difference between a phantom stock and stock appreciation right is that when you say phantom stock, it is the total value of the equity itself, whereas in stock appreciation rights, it is only the differential. So say, for example, you have an employee who joins the entity when the valuation is around roughly 250 rupees. And subsequently, when he is entitled to the benefit, the value of the particular stock grows up to 750 rupees. Now, what the particular employee would be benefited is not to the extent of 750. It would be 750 minus the value at which he entered. So it is a form of these cash payouts can be customized in order to suit the requirements of the company. So in this case, a person who is part of an organization for longer would actually benefit for that amount of differential and much more as compared to a person who joined the organization later. So these are the two different kind of variants that we have commonly seen in the current times, and which has found usage by a lot of startups who are looking at alternative ways to equity plan. So why these kind of cash settle plans? One of the major reasons for having adopted these cash settle plans is because it ensures that there is no promoter equity dilution. The people, though they are entitled to benefit, which is tagged to a value of the stock, what that they get, they're not actually allotted equity, and there is no stock allotted to them. So there is no concept of they being part of the cap table of the particular company. So that's why these kind of incentive plans have found a lot of takers in the current stage. Now, the life cycle of this is very similar to that of an ESOP. You can drive the plan very similar to that of an ESOP. It will have a grant. You can create a pool for phantom stock units, saying that so many units and one unit can be equal to value of one share. And it will also, you can also have the similar vesting schedule as to an ESOP holder, where the units doesn't immediately accrue to him. That is, the number of units for which he can be cash settled will not immediately accrue, but it will be dependent on how long they are associated with the entity or based on certain performance conditions. The major difference is that instead of exercise, we have concept of settlement. You will have just similar to an ESOP scheme, you will have a SAR scheme or a phantom stock scheme. The only thing the major differential would be that you will have a specific liquidity event, which will be like a call out saying that is the trigger of that particular liquidity event is when the cash settlement happens. So it specifically calls out a liquidity event. The liquidity event can be anything such as it can be a major stake sale or there is a huge change in the management or the control. All these can act as a trigger point for providing settlement to the employees under this particular scheme. Now, over to you, Arun.
Thanks, Mythili. So for explaining how the phantom stocks and SARs are different from ESOPs or sweat equity and how simple it is. Of course, the simplicity is one of the benefits of these plans, these structures. So let us understand quickly the benefits of these, different structures. One is cap table management. What do I mean? What do we mean by saying cap table management is? Since these are shadow stocks or phantom stocks or ghost stocks, the stocks or the units allotted under this scheme to the eligible person, be it employees or vendors or directors, whoever it is, the actual shares are not allotted. That means they are not shareholders in the list of shareholders on ROC, in the ROC, that is MC records. That being the case, they do not have any rights whatsoever that a shareholder would enjoy otherwise under normal circumstances. So that being the case, one, the promoters and the investors are rest assured that there is no interference and it is easy to manage the cap table. That is one. And payout of taxes, payout happens only when there is a liquidity event which is defined in the scheme, and hence there is no concern or a situation where the board has to think about the payouts because it is well defined. Number two, only when the payout happens, the tax impact triggers for the recipient. However, compared to this, in case of ESOPs or sweat equity, whether the cash is received, before even the cash is received, the shares are allotted. And hence, at the time of shares being allotted, there is a perquisite tax on the perquisites. And hence, that also is overcome here. Next is remunerating external consultants. Generally, sweat equities or ESOPs are not available for external consultants. And hence, these structures, that is phantom stocks or SARs, can be used for remunerating external consultants. Next, interference from ex-employees. When I say interference, of course, there are a lot of situations where all the shareholders' approvals are necessary, signatures are necessary as part of liquidation event or exits or M&A, mergers and acquisition situations. That being the case, tracing and then compliance and the logistics issues are overcome, and that being they are not shareholders on the shareholders list. So hence the interference is less. Of course, ex-employees joining, there are situations where we have seen ex-employees joining competitors and then that becomes conflict of interest. Those issues also can be overcome here. Next is ease of implementation. Of course, it is very easy to implement. The reason is there are no regulations that govern on the operational matters of these structures. Only the taxation matters are captured. Only the taxation regulations apply and not on the operational matters. And hence it is very easy to implement. Yeah. Over to you, Mythili.
To address the accounting and taxation, the requirement for accounting and valuation would work more or less similar to that of an ESOP. The only difference is that in an ESOP, only at the time of grant, there is a requirement for valuation, and at the time when the liability is crystallized, you have a valuation requirement. But in case of phantom stock or a stock appreciation unit, once the units are provided, then it gets the liability will have to be restated every year, and the carrying value will have to be restated in the books and carried as a provision every year. Now that is one. And with regard to the impact on the employer, since these are cash settle schemes and the trigger for liability happens based on a future event, there is a possibility that these can be called as a contingent liability. And as in the case, since we had, as we saw in the previous with regard to taxation for ESOP, if it is a contingent liability, they may not be allowable as an expense. Hence, this is likely to be allowed as an deductible expense only at the time of excise. That is when there is an actual cash payout. The TDS certainly will follow along with the cash payout, and only when the liability crystallizes, there is a requirement for withholding. Now, coming to the employee, it works very similar as that in case of an ESOP. There is no trigger for taxation either at the time of grant or vest, but at the time of exercise, whenever there is a payment settlement event that is triggered, at that point of time, you will have since there is a payout that is happening, you will have it will be considered as taxed in the hands of the employee, and he will have to bear the liability at that point of time. Now, I'm just going to briefly touch upon the one more aspect, which is with regard to GST. Since these kind of benefits actually accrue to external consultants, there is a liability exposure for under GST. It is an area of contention where you will have to demonstrate as to why, because since the service is provided as on date, but the the taxation, but the payment doesn't actually happen on the date when the service is provided and it's a future event. There might be, there is a gray area that is exposed where we say whether the GST is to be based on at the time the service is or whether it is the time of settlement. But since it is, even though it is a contingent liability, since the service has been delivered, there might be a trigger for GST compliance at the time when the units are actually offered. One of the bases for looking at is because you will be carrying also the provision in the book. So that can be a mechanism in order to ascertain how much would be the value of the service.
Thanks, Mythili. Thanks for explaining the accounting and regulatory aspects. We have launched another poll. Please request you all to exercise the poll. It can. So we will move forward. The poll is available again in the chat. Please exercise. Meantime, we will move forward. So what can be done with respect to these long-term compensation plans? So one is advisory on compensation plans. So it has to be very critically structured, as Mythili explained, into and nitty-gritties has to be maintained, and assistance on drafting these documents, assistance in implementation, and also valuation services and other related advisory during the course of these uh, plans existence. And here comes the end of the session. Or as we all know, all good things come to an end. So we are, at the end of the session, of course, we are not letting you go. We would want to get into the Q&A session and let's make it interactive. I think my colleague will be opening the mic access to all of you. Request you to unmute and ask your question or post your questions in the chat, which we will try to take it up and then address one by one. You can raise your hands. There is an option to raise your hands, and then we will address it. So the first question that has come up is from Ms. Aarti Mohan Ram. Her question is role of RSU similar to ESOP or is it different? RSUs, it is nothing but restricted stock units. Again, it is more or less similar to ESOP, but what we understand is RSUs again is not regulated under Companies Act in India. It is more so towards the concept that has come up in US. And however, the more or less the accounting aspect and the tax aspects are similar to ESOPs. Okay, there are a few hands raised. Let me check.
Arun?
Yeah, Mahesh.
Yeah, there are a couple of questions in the
Mahesh,
Q&A.
can you be little louder?
Couple of questions in the Q&A. Can you take those first?
Let me have a look at it. Whether allotment or to ESOP trust at inadequate consideration will be taxable in the hands of ESOP trust. Mr. Dikshit, as we understand, Section 50 CA applies and Section 56 applies here, even for ESOP trust. So the allotment of shares at a value less than the 11-year valuation would get triggered, would trigger the provisions of Section 56, and hence it would be taxable in the hands of ESOP trust. I'm just scrolling the chat section. Q&A. Let me go to Q&A section
No,
also.
not in chat, Arun.
I'm
Go to
going. I'm
Q&A.
going to Q&A. Yes, I'm going there. So the first question Mr. Mahesh comes up with is there any legal binding on phantom stars, considering there is no share allotment in case the company backs out from the commitment? Very interesting question. Mr. Mahesh, to answer this, uh, whenever SARs or phantom stocks are granted, it is an agreement between the company and the grantee or the person or the recipient. Hence, it is an agreement which is recognized in the eyes of the law, and it can be contested before the courts. So once the agreement is signed off, I think they are contractually, the company is contractually obligated to perform its commitments, and hence whenever there are non-performances, you can take the company to the court of law. So that is one. Are you aware of any other alternates? Okay, sorry. Next, is the shares issued to Indian employee as per recent changes in FEMA regulation? Mythili, you would want to answer this? You can unmute.
Yeah. No.
So the question
Yes.
says, I'll repeat, is
Is
the
the
shares issued to Indian employee under ODI as per the recent changes in FEMA? So let me rephrase as I understand. Are there any changes to the regulations for allotment of shares under recent changes?
Now, as we understand from the new ODI regulations, there is a specific call out with regard to a new concept called as control. Now, initially what had happened is ESOP had always had a specific call out under the ODI regulations, even the previous as well as the new regulations. But now they have defined the concept of control that even though if a person is allotted shares, they have created what is called as a threshold, saying that up to 10%. If a person is allotted, it would be considered as an OPI. Now, if it is more than 10%, then it can go into what is called as ODI, and then you have a multiple compliances under that. But if it is less than 10% and you do not have control, then it would have the same requirements as how an LRS has, and the person can make a remittance. So that is the main aspect. The concept of control has been brought about here now.
Yeah, I mean, thanks, Mythili, for the brief explanation. Of course, that is altogether a different subject matter that we intend to take it up in future about or new ODI regulations. So going to the next question, how to view when it's not a startup but entity provides ESOP or stock incentive plan? Is stock incentive plan different than ESOP or RSUs? Okay, stock incentive plan is synonym for ESOPs, and that is where we also named this session as compensation plan. So under compensation plan, there are different structures that we can adopt. One is ESOP, one is sweat equity, the other is phantom, the other is stock appreciation rights. Now, coming to the first question, when it is not a startup but entity provides ESOP, yes, it is possible the entity can provide and grant ESOPs even when it is not a startup. However, the exceptions that are provided or exemptions that are provided to startup are not available, which is that payment of taxes for a period of 5 years or other conditions related, and directors being eligible, promoters being eligible. Those exemptions are not available for regular entity or a non-startup entity, and hence the moment there is an exercise, the tax liability is triggered. So those are all the consequences of not being ESOPs being provided by a non-startup. Hope I addressed your question. The next question by Mr. Sharad Deshpande is, do restricted stock units also follow all the same guidelines as ESOPs? If there are differences, can you please call out the same? Thank you. So, as I mentioned earlier, restricted stock units is not a concept under Indian regulation, at least under Companies Act. And hence, what happens, any stocks that are granted to employees of the company, it has to follow the regulations framed for and with respect to ESOPs. So whether you call it as RSUs or not, ESOP rules and regulations has to be complied with. However, on the vice versa, that is where an employee of a subsidiary of Indian company getting RSUs of a foreign entity, there again, all the regulations, accounting aspects has to be followed as per whatever is applicable for Indian entities. Is there 1 year minimum period applicable to performance-based vesting too? This is the question by Chetan Dharamshi. Yes, even when it is performance-based, 1 year minimum vesting period has to be complied with. So just scrolling. Okay, the next few questions here. Is there any legal binding on phantoms? Okay, that is what we have addressed. Is valuation as on grant date in case of ESOP compulsory? What are the consequences if valuation is not done as on the grant date? Mythili, you would want to take this up?
Sorry, can you just once again?
Is valuation as on grant date in case of ESOP
Okay,
compulsory?
so what we generally recommend as part of valuation requirements is that it is not feasible for us to sometimes take valuation at very shorter intervals. So as a practice is what I can advise you, where we say that if there is no significant events that has happened between your last valuation report to the current valuation report, it is all right to take the previous valuation report. But we generally suggest that to if there is a significant customer or there is a significant growth that has happened, or there is a good amount of traction that has actually resulted in an increase, or you have a fundraise which is very close by, which has resulted in the value increase, do go with it, and it would be easier to just comply and get that valuation done rather than take a valuation report which is very very old, or you which was taken prior to having a certain major event. So it is easier to justify, but we do understand that sometimes grants are done over a period, say probably within a quarter or 6 months, and there might be a very short duration. It's not feasible to take. So we have to generally understand what is happening with the company to take a call on that valuation. And usually when you run it by the registered valuer, they generally advise you based on the scenario.
Yes, the added question there was, Mythili, what are the consequences if valuation is not done as on the grant date? So you may consider tax as well as accounting.
Accounting would be the main thing. It is also you losing out so much of more of the expenses. So if there is a movement in valuation, there is more that you can actually claim as an expense and provide, right? So that is also, it is also you losing out from the company's point of view. So general practice, at least minimum 3 months as a thumb rule, we generally say 3 months old valuations.
Thanks, Mythili. So I'm just going through the chat box also, if there are additional queries. whether allotment to, okay, that we have covered.
Okay, one more question was there with regard to are there Indian companies implementing Phantom's SaaS options? Yes, certainly. We have actually assisted quite a bit of our clients with regard to Phantom stocks and SaaS options. And we have seen of late quite a bit of traction in that aspect as well, because the bottleneck that people generally face is that they're not able to provide equity to advisors. And how do we do it, and the compliance around that? So they find it very easier to implement Phantom and SaaS option for those scenarios. And what is the liquidity event for a Phantom or SaaS? As I had covered in the PPT itself, it would be a major trigger event where, so for example, where a management loses control and you have some major shareholder who actually comes on board and he would be taking over the management. You know that the earlier management is not actually going to take it forward. So those are the kind of a real trigger events which would call out. The management usually are cognizant of that when they actually draft out that plan. It's well thought out, and they generally specify saying that it's sometimes a 50% dilution of equity where they lose the majority stake. Sometimes they call out as a reason for liquidity event.
Yeah, thanks, Mythili. Of course, we have Mr. Sanjay, who has also, recommended that this can be shared. The video, we will now try to share the video of recording of this session, or at least we will try to share the PPT of this session to all the attendees. And Mr. Sanjay also recommends create a closed group Facebook where it helps the amongst the community, the professional development amongst the community. Of course. Sorry.
Go ahead, Arun. There was a small thing. Go ahead.
Understood. So as I mentioned, of course, we would attempt to do create Facebook group. However, we have also, we keep posting our brief snippets of these kind of aspects on LinkedIn. We would request you to subscribe to follow our page, and we keep sharing interesting thoughts over there. And of course, and our going forward, we intend to increase the number of such webinars. And since we have your contact details, we would also be sharing all the details upfront with you. And we have 5 more minutes for as part of our Q&A. Please post your question or unmute and then shout out your question. We'll be happy to address. You could reach out to us on our email. So Mythili, I think we have not shared our emails here. We will write the email to you all with our contact details, and our contact details are also available on our website www.anvation.com. We'll be happy to interact further. Any more questions? We're happy to take it for next 4 minutes.
Hi, sir.
Yeah, hi. Go ahead.
Sir, if entity is a non-company, it's not a company. Is there any way to achieve a similar objective, or is there any similar instrument?
Hi, Sarvesh. So it's a very interesting question. Yes, of course, we cannot implement ESOP. We cannot, implement or adopt sweat equity route. But however, phantom stocks route or SARS route can be adopted, and I feel there is no restriction whatsoever for us to adopt those structures.
Okay, sir. Thanks.
Yeah. That was a very good question. It all depends on how we can document it well and how it can be implemented with watertight documentation. Would request the members to share more questions. We have another 2 minutes. Mythili, you're on mute. You're saying something.
Once DIPP approval is startup, do we still need to get an approval from interministerial board? Now, this interministerial board is required if you want to pass on the benefit of postponement of the perquisite tax. And also, companies are eligible for a certain extra benefits, which is on the profits under 80 IAC as a eligible startup. So for that, you need to make a specific request, and you have a specified form when you log into Startup India, and you will have to make an application specifically, and you have to get a certificate back based on which you will be eligible for that benefit.
I think my colleague will be sharing a feedback poll also. Request you all to please exercise your poll. I request you all to exercise the poll before we say thank you and goodbye. In the meantime, I would, wholehearted, gratitude to you all to make out time on this Friday evening and participate in this session. It was wonderful to have you all here, and then we were happy to share our knowledge, what we know, and exchange information. Of course, the participation was great. There were queries raised, and we have attempted to address those things. And if there are any more, please do reach out to us, and we would be happy to address them also. And we hope we have made a change in your thought process about ESOPs or any other structures that we discussed. And then we would also request going forward to participate in our future webinars also, and we'll be happy to have you as part of our guests. So with this, I would,
Thank you, Arun, and thank you all so much for a very interesting session. Thank you so much. I hope it was beneficial, and it has you have at least taken something from this particular session. Do reach out to us for any queries or anything. We'll be happy to address.
the poll is in the chat itself, Mr. Sanjay. You can use that to provide your feedback. Thank you one and all.